Hey guys, what's up? Hitori here. Welcome to episode 33 of the weekly market outlook with TradXProp. In this episode, I'll be covering the DXY, S&P 500, Nasdaq, Dow Jones, gold and silver, Bitcoin, and also a bit on Treasury Bonds. If you have any other asset classes you would like me to cover, just leave a comment down below, or even better, join our free Discord server where you can talk to me as well as the TradXProp team. And speaking about Discord, we also currently are running a Discord invite competition for our Discord server. So if you are interested to join, you should get into it before the 31st of January, where you can win up to the prizes stated here. Okay, so let's get straight into the core content. First off, Happy New Year, and let's get this bread. Okay, keeping it sweet and short, not much can be said. A new year doesn't really signify much in terms of your trading journey. It should just be just another day for you. Okay, so now in this episode, I chose to cover a lot more than I usually do for a few reasons. The first one is actually because it's a new year, I do kind of want to give like an overall outlook into, more asset classes, like a more long-term forecast, you could say, instead of just a typical weekly outlook that I always do. So I chose to cover a lot more asset classes in this video, but that just means that I won't be able to spend a lot of time on each of the pairs that I will cover, right? But that's fine. That's fine. We will still upkeep the quality of the forecasts on this channel, so do not mind the shorter focus time. All right. So without further ado, let's get into the content. So first off, let's look a bit on the US GDP growth, okay, which is pretty much the backbone of our analysis, as well as for others who focus more on the economic growth and policy environment. So the US GDP is actually expected to continue its robust growth, mainly fueled by strong consumer spending, low unemployment rates, and also a positive business climate. In fact, many analysts are particularly watching potential policy shifts under the Trump administration, which I think will be sworn in next week, if I'm not wrong, in almost the mid of January. We're expecting things to come in, stuff like tax cuts, and just overall less regulation, which, as you know, also further stimulates economic activity, right? So we are expecting strong GDP growth for the US coming into quarter one, or maybe even quarter two of next year, which is pretty much the short-term to mid-term forecast. So as of now, good US economy, let's keep that up. But what kind of supports that is that on the fiscal and monetary side of things, the Fed is still anticipated to cut rates in 2025 this year. This could be quite a game changer for investments or people looking to get involved in trading stuff like equities and commodities, like gold, which is going to potentially weaken the dollar. Okay, so strong economy, rate cuts, right? We're gonna see lots of momentum and volume coming into pushing these risk-on assets, like stock markets or gold. So with that in mind, what do we see on the DXY, the US dollar? Well, as of now, it's still coming into, of the backbone, coming off of this large bullish momentum, right? We could see it come all the way up, likely into around the 110 area. Right here, we do have this structure point scrolling all the way to the left. We have this area of resistance. So as of now, I think that 110 is an area which is not too far off as a target. We definitely could see price reach up into the area, and then we'll decide, you know, where we are going to go from there. Of course, this reaching of 110 is under the assumption that we see continued economic outperformance by, you know, other asset classes, right? So against other currencies. But on the off chance, you know, the euro and pound, we're actually expecting it to weaken due to just overall less vigorous and less aggressive economic performance in both the Europe and the UK. The yen also could further depreciate due to dynamics in the carry trade that we saw unfold last year in around, I think it was August, right? We saw this huge spike down in many asset classes due to the yen carry trade being unloaded, since it was the first time in a long time that Japan has actually raised its interest rates up to this extent at that time. So here on the DXY, let's just do a bit of technical analysis and, you know, not too much on the FA side of things, on the fundamentals. Here we're seeing price breaking above this previous area of resistance. If we scroll back to the left, this was a structure point right here. Price actually broke above it with momentum, and now we're holding right above the 107 mark, and we're pushing higher. All right, we have reached the 109 mark as of now, and we're showing some reaction, failing to push above it and close above it, signaling strength. So I think that this reaction is going to be a continued pullback into lower prices to push higher. Seeing just how strong the economy of US is currently performing, and also seeing how we are expecting Trump to bring in more things for the US, we're expecting just an overall stronger dollar. Okay, so definitely any dips for now are going to be pullbacks into supports to form long ideas off of. You know, right here we have the 107.8 mark. Below that we have something around 106, and then further down we have some of these areas of structures and supports right around 105. Okay, so I'm expecting this run on 1010 to be relatively quick. Okay, expecting it to pull back maybe into this major area of recent support, this RBS resistance broke, becomes support. I'm expecting price to reach there and bounce off, but of course it could just come into this range right here, the middle of this range, form support, push higher. Of course it could, but as of now, based on current price action, this is that reference point that I'm currently eyeing at. If we break beneath it, it depends on how we break, of course. If we break hugely like this with a big bearish candle that kind of covers the entire range, there really isn't much I could do for short ideas. But if we do break beneath slightly, I would like to see price retest that area of 107 as a potential break and retest. Short-term sell idea down into new structure points below. Okay, same thing as every time. It all depends on how we break and close above or beneath a level. Okay, so that is what I'm looking at for the DXY. Next up, we're going to be looking at the stock market indices, S&P 500, Nasdaq, and also the Dow Jones. So for the S&P 500 right here, let's look at it on the ON data feed, right? So the S&P has kind of been in a really easy to trade area. Like, come on, price form resistance, pull back to support, breaching resistance, comes back, break and retest trade of this previous resistance, pushes higher, and then now we're just stuck within this range. And at the moment, you know, based on fundamentals at least and sentiment, I am actually still bullish on the indices, right? Because we we likely see a strong foundation of growth, especially in tech-heavy indices like the Nasdaq. For those that don't know, the so-called Magnificent Seven tech companies, which are just the largest 7 companies, are leading this bullish charge, mainly focusing on AI innovations, which promises higher productivity and profits, which in turn just pushes the stocks higher, which also leads to the indices, which are just a basket of shares being pushed higher. In fact, let's actually look at the tech-heavy Nasdaq right here on the ONDA data feed. Where we currently are is that if we look to the left, obviously we are at all-time highs. It's a really crazy, bullish charge higher. And the thing is, we are at premium prices, like the top premium of the premium, right? And while it definitely is a scary place for investors and traders to buy at for like a long-term swing, you have to understand that even if these prices are considered high, the market could actually justify these levels if earnings continue to grow and if inflation actually stays in check. And I understand that, right? Because looking here, people are like, oh, it's too high to buy. But also, it was too high to buy here, here, we're right in this dip. This is actually the yen carry trade. But all of this entire leg up, people were telling everyone that it's a bit too high to buy, right? So you could definitely approach it more cautiously. You could look at large pullbacks of like 4 or 5% and look for an entry in. That's cool as well. Or if you are too afraid that you might miss a move, you definitely could just get in at current areas of major structure points to look for just smaller entry positions to make sure that you at least are in the leg. And that doesn't necessarily mean that you're going to have large upside, of course, but at least it means that you have capped your losses to a smaller than usual position sizing. Okay, so sure, let me just go back to the S&P 500. Large cap, strong, yes, we all understand that, but we could also actually see small cap companies see significant benefits from the interest rates being lowered, given just how domestic focused they are in the US economy. Policies promoting US manufacturing could actually further tilt the scales in the favor of small cap stocks. So things like the Russell is also likely to increase. So let's move away from the fundamental side of things for a bit, and let's kind of look at the technical side of things. Like, are the technicals agreeing with what we are actually seeing on the breakdown of the fundamentals and sentiments? So right here on the S&P 500, we're currently caught within this large range of around 2,000 ticks, or around 3.5%. That's quite big. We have come into this major area of support around 5877, and we've also closing bullish quite strongly at this support, which is a great news because I'm still expecting higher prices, of course, but we are at the extreme point of this range and we've closed bullish. So what that means is that if the market could continue to push higher, looking left, we have clean traffic to support this forecast that we are going to see higher prices. Of course, if we do, break beneath this level, we could be clearing off some of these liquidity wicks, or we could even come back down to clean this clear traffic down to 5.7k. That's also completely possible. But definitely potential pullbacks around the line for you to get in long, in my honest opinion. I don't think we should be seeing bearish stocks bearish indices as of now, especially when the price action is so clean on the S&P 500. Definitely expecting prices to come higher, to retest at least the 6K mark, and if you break above it, a break and retest is, in my opinion, underway. Okay, so that is for the S&P 500. Let's take a look at Nasdaq. Let me just go back to the ON data feed. So Nasdaq is also showing a similar picture right here. I mean, it's similar, but it's not exactly cleaner, I'd say. We have support right here at around 20K, of course, 20.7K, and we have rejected this area with long wicks, also closing strong bullish. So of course we could mirror that move higher into around the 21K mark or even the 22K mark, and then potentially showing us a break and retest movement if you do go bullish from here. If you do break beneath 20.7K, this isn't exactly a clean area. I want to be looking for short-term short ideas, but breaking beneath 20.4K is a different story. We could be seeing price correct down into some of these structure points at around 19K, but do keep note, if we do break beneath that mark, we have almost broken down beneath 5%. So depending on where we currently, where we come down from, of course, and where we decline from, this could be a place for you to say, well, hold up, let me kind of reevaluate what the sentiment is looking like to make sure I'm not getting in on the wrong side of things after sentiment has shifted. Okay, so that is the Nasdaq and S&P. Let's take a look at Dow Jones right here. So same picture, we saw that large decline across all three major indices, and we're finding support right now at around 42K for the Dow Jones, right? If we break beneath this area, I definitely do think we could correct down a bit, down into this previous area of structure, or down into this support at around 41K. But if you break beneath that, clean traffic once again, definitely think we could come back lower into 40K. But we might just continue ranging for now until we see some kind of crazy news release come out, which next week happens to be NFP. So definitely keep your eyes peeled for that. Breaking above 43K, I would want to say that this is clean traffic, but it's not really. The body of the candles are small, relative to something like this, so it's not exactly clean traffic. But on the daily, at least, there isn't any clear area of resistance right here in this range up until 45K. Okay, so if we do see this break and retest, it's still a good trade idea to take, but just understand that there's something maybe on like the 4 hour that is going to signal to you that we could have like a short-term reversal from there at least. So with the markets in this scenario, do keep in mind that next week we have all of these heavy news releases. On Friday we do have big old NFP, so keep in mind when you're trading next week, because just before that we also have FOMC. So definitely a sketchy week to say the least, but nonetheless still definitely possible for intraday trades. All right, okay, so now let's wrap things up for the US market, and let's take a look at commodities, right? Let's take a look at gold. Gold, yeah. So if you recall, I kind of said that gold was forecasted last year to reach 3,000. Personally, I didn't really believe in that. I do think we're still going to reach it this year, but definitely not last year. And as you can see, we didn't reach it last year. Okay, so the forecast for 3K on gold, it's still on the table. driven by its role as a hedge to inflation and also as a safe haven for tensions, just global tensions. Silver, although less aggressive, it probably is likely to just climb higher alongside gold from just industrial demands being increased from regions like China, right? Because China just recently announced stimulus. So once that region recovers, the industrial demand for silver is likely going to pick up. But right here, right now, we're focusing on gold. Okay, so last year I said, not last year, technically it was last year, right? Last year I said that if we do break beneath this area of support right around 2.6k, and if we close bearish beneath it, I would take a trade like this. Now the question and the only issue is that when we broke beneath this level, look at how much it pretty much cleared off that range. Half of it was pretty much gone. This big dip lower was like like this. It was like a 400 pip drop, right? And it pretty much cleared off the range right here of around 650 pip. So when we form support here, you understand that when we do have a break and retest scenario like this, how far have we actually cleared off that range? Because if we come back to this area of SPR, support breaks become resistance, we come back lower, this is now the next area of support you have to be careful of. And you have to be careful because fundamentally we are in a place of range, right? We are in a place of not uncertainty but just range. So seeing as how it was December, you could likely expect some chop. So once we had this large break to the downside, did I say September? I mean December. But once you saw this break to the downside and you're expecting chop, break and retest might not be the best case scenario. Of course, if the level was here, and then we broke it like this, sure, we do still have range to play from. If this level wasn't here, of course we have range to play from. But unfortunately, we don't get that, and instead we get a big break covering half of that range, retest that in the end didn't really amount to much. So this idea is now invalidated. Okay, but I just want to put that line there to kind of showcase to you why the idea wouldn't have been valid in the first place. Okay, but as of now, we're still caught within this large range, forming a lot of internal structure. Recently we formed resistance around 2.6k, and if we do break above it, I do think we could come up retesting this high, making a potential triple top. But because we have clean traffic here, this triple top is definitely possible. If we do break beneath here, unfortunately there's not really much plays to be made other than longs from supports. I won't be looking at any breaks of these supports to short from unless you're a scalper or a super day trader, because they're just close to one another, like super close. Like this is like 2.6k, this is 2.58k, crazy. So definitely these are areas to long from if you're swing trading, but definitely no areas to short from until at least we break beneath 2.558k. We could come down to retest this week and come into this previous area of accumulation. Okay, definitely looking for this area as a potential support, but we will decide once we come to that area, and we will be seeing how we break beneath those areas in the first place. Okay, so that is it for gold. Let's take a look at Bitcoin. So Bitcoin is a pretty feisty one, I'd say. I know some people have really far-fetched targets of like 1.25, 1.35, sorry, 125k, which is not a it's not far-fetched, but based on where we currently are, I'd like to at least break above the previous all-time highs right here to then say we're going to be reaching for like 1.25k, right? But definitely not a far-fetched level. It's just a bit too far from where we currently are. So next year, or sorry, this year, I do think that the crypto market's gonna be booming, right? Because with Trump in office, Elon Musk being his right-hand man, both being very strong public advocates for crypto, we are likely to see bullish runs based on market momentum, just overall broader adoption, and maybe possibly even more favorable regulations, seeing just how Trump and Elon are, just big fans of crypto. I don't have a set target for Bitcoin as of now, but a good one could probably be 120k, right around here, right? Could definitely see price once, of course, it comes down into some area of support, breaks resistance, you could get in long. I am personally eyeing some of these areas around here as really good pricing to get in. If we do come down to it, definitely looking to DCA in some of my positions, or at least do like a large one position on some of my accounts to just get straight in, depending on what your risk tolerance is. Of course, I've always been a big advocate for DCAing Bitcoin or crypto in general as like a more mid-term investment. But if you're trading, definitely trading within these levels are fine. Unfortunately, if you are trading based on technical analysis, we don't really have much to go on. We're caught within this previous low and high, ranging between these levels. If we do break above 99.446, we could see this break and retest to go higher, clean traffic, maybe even see that new to all-time high being made. But if we're trading within this level, just bouncing up and down, sure, short-term buys and sells, definitely is possible, but that's about it. Just doing ping pong. Breaking beneath this level, we have been shocked, because I think if we break beneath 86k, we could see price come all the way down into 73k right here. Clean traffic, nothing to stop this momentum move push lower. Okay, this is actually like my second time recording this part, because I actually realized my mic suddenly turned off. Let me just actually check real quick. Yeah, it's still turned on, thank God. But just all of those things are kind of like messing up my my speech. But last but not least, we have the Treasury Bonds, which is actually the 10-year yields. And for those that don't know, I'm a big fan of using the 10-year yield to kind of see where the DXY is likely to head, right? Because the 10-year is pretty much a soft spot for, not soft spot, but like a sweet spot for market cycles. In 10 years, we are likely to see multiple periods of recession, of recession, of recovery, of market momentum boom, all that stuff. So the 10-year yield or the 10-year bonds, really, both of them are kind of like just sweet spots for me to look at. So as of now, we are expecting steady yields, unless we see inflation spikes, of course, which if we do see inflation spikes, we are likely going to require higher returns to offset those risks tied to inflation. So as of now, inflation is still chilling, so we are likely to see yields also still chilling, likely to range between this 4.4% to 4.6% mark, this large range right here, until we break one side. I think that if we do break beneath here, I'll have to reevaluate where the current market sentiment is. And if we do break above 4.7, I'm likely to also be going to be looking and reevaluating what the current market and sentiment stance is at. Okay, but as of now, just ranging between these two levels seems to be the play is where we're at right now. All right, so we covered quite a bit of things. Now remember, these forecasts, they're based on the current state of the markets and understand that the markets, in the long run at least, are inherently unpredictable, right? You should always stay tuned to real-time market movements, which could shift these projections. Like I said, it's always how we break those areas and why we've broken them out of, or when we break out of them, that decides how important the move I'm expecting is likely to happen. Of course, I'll be doing the market outlooks again on a weekly basis. Last year I did take a break, seeing as how December was not moving that much anyway. So I'm pretty sure none of us really missed anything important. I personally didn't even trade the entire of the last 2 weeks of December. So yep, keep your investments informed. Keep your trades informed. I'll see you guys in the next one. Peace.